This episode is brought to you by SmartVestor. Connect with an investing pro near you at RamseySolutions.com/SmartVestor.
Joseph is with us in Fort Worth, Texas. Hi, Joseph. How are you?
Hey, Dave. Hey, Rachel. How are y'all doing today? I'm doing pretty well. Can't complain.
Cool. How can we help?
So I wanted to get your guys' opinion on bonds. I'm just starting to. I feel like I've just dipped my toe into stocks and things like that. But I've looked into oil and gas bonds, and I don't know if that's a good route. I have about $500 in my HSA that I want to use to invest in that. I have more money to invest, but I'm just asking specifically, I guess, about that, and then any other advice you have on just stocks and trading in general.
Okay. I don't buy bonds. The bond market in general is almost as volatile as the stock market and doesn't return as well. So it's pitched in the financial world as being safer than the stock market, but the actual data says it's not much safer. It's the volatility in the bond market comes from shifting interest rates, and so I have avoided bonds. I don't own a single bond, and I've got millions of dollars in the market. I don't own any single stocks because I don't like risk. I own mutual funds. A mutual fund is 90 to 200 different stocks. My HSA is in mutual funds because I've never actually used it. I bought the HSA the very first year that George W. Bush put that program out, and I filled it completely full every year ever since, and I've never touched it. Whatever medical we've had has been very minor, and I've just paid it out of my pocket, and that basically has become yet another retirement account that is growing tax-free. For medical use and above 65, which will happen in September, I can pull it out with only paying taxes on it, no penalties, as if it were a retirement account. So I'm going to continue to fund that, and I'm not even going to pull it out at 65. But anyway, so all of that to say, I invest in mutual funds, and so if I put, I don't know, $100,000 into the market, 0% in single stocks, 0% in bonds, 100% in a type of growth stock mutual fund of some kind or another, and that's going to be 90 to 200 stocks in there. And so I've not bet. The volatility from single stocks comes from the lack of diversification, meaning that if you put $100,000 in one company, whatever that company does causes you to take your breath away, positively or negatively, and so it's a lot more risk. But if you're instead of being in one company, you're in two, then if one company goes crazy, the other one's sitting there, you got less risk. If you're in 200, you've way limited the risk, and the only risk you're riding is just the risk of the general stock market as a whole then, and not simply betting the farm on one particular company based on your golfing buddy's hunch, which is how most people play single stocks. And so I don't trade stocks on a daily basis. I don't trade mutual funds on a daily basis. I have the buy and hold tortoise in the hare. The slow and ugly guy wins the race every time. I'm perfectly content being the slow and ugly guy because I win the race every time.
Yeah, and I think that's the hard message for, I want to say maybe the younger you are, the harder it is to be like, okay, this isn't exciting. You know what I mean? Like there's crypto, there's all these things happening, and it's like, ooh, I could make a return there, do this thing. There's like this game to it.
Well,
and when there's not really
temptation to be a player.
Yeah, when there's not a game to it and you just kind of just keep investing,
it's
and
just boring as
that's
crud.
it. Like there's just
boring.
not that much excitement around it. Usually you're going to end up
if you're investing is
having
exciting,
perseverance.
You're doing it wrong.
Yeah. And it's kind of depressing. I mean, seriously, it is a little bit like.
Yeah, if your broke friends are impressed with your investing, you're probably doing it wrong. You know, because it's always some broke guy that runs up to me and goes, "I know this guy that put $10 million in Bitcoin," and I'm like, "Yeah, I bet you do. I bet you don't too. I bet you're full of crap." You know, and seriously, people just come up with this stuff. They pull it out of their ear. People that aren't really doing it.
Well, and there are so many trends and so many things that kind of come and go. And so it is the longevity of what you're putting your money into as well. which means it's been around for so long that no one really talks about it because it's that boring. It's not new and exciting.
Yeah.
And so
don't you wish you bought a single-family house on East Ridge Drive in Antioch, Tennessee, a suburb of Nashville, in 1978 that I sold a guy when I was 18 years old, got my real estate license. I sold one of my high school buddies a house for $42,250.
This is why we hate the boomers.
Do you know what that house is worth now?
We're so mad at y'all.
You know what that house is worth right now? Yeah. Don't you wish? But see, that's what you want to.
That's who you want to be.
No one ever told you that this was going to be, that you're going to make $1 million in 20 minutes. But in 40 years, you did make $1 million because that's what that house is worth now.
Yeah. Yeah. So.
And by the way, it's an old house now. So. It's a really old house.
Still worth a lot, though.
It's an antique. But yeah. But I mean, that's just a cute little brick house, nothing fancy.
Okay, so for Joseph, so you're saying mutual funds, but something else that I feel like people are talking more and more about is like Vanguard index funds, like more the S&P and all of that, too.
That's been talked about for a while. Vanguard was started by John Bogle because he discovered that some 60% of the mutual funds do not outperform the Standard & Poor index. And he said, if I just put it in the index, I beat 6 out of 10 times, I beat the average mutual fund out there. And people that follow that is literally passive investing. Mm-hmm. People that follow that we call them Bogleheads. They call themselves Bogleheads. And he started Vanguard, the whole Vanguard company, on that basis. Mm-hmm. And it's very successful.
Yep.
And I invest in the S&P some.
Yeah.
I park money there, like when I'm piling up cash to get ready to do the next real estate deal. When I make some money at Ramsey and I'm just putting it somewhere for a year or whatever till I get enough to do the next deal. And I'll park it over there. But in my retirement accounts, I can find mutual funds that outperform the S&P, and I have consistently for 30 years outperformed the S&P, yep. And it's really not rocket science. But there's only 40% of them. So you just got to look and go, does this thing outperform the S&P? Mm-hmm. It's right there in the dadgum prospectus. It shows up on the website. Yeah. It shows up when you're sitting with your
and that's
financial
within
advisor.
Your HSA, 401k, Roth, like all the just standard retirement investing. So Joseph, 15% of your income, be putting in all of that, and then if you max all that out one day because you have a high income, then there's other things.
It's the shortest distance to $1 million. It's the shortest distance to wealthy. It's not bonds. It's not single stocks. It's not day trading. It's not crypto. There's no data that says it is. The only data says 401k, Roth IRA, loaded with good growth stock mutual funds, and get your house paid off. That's what all the wealth building data says for the first $1 to $5 million worth of net worth. And the people that have $1 to $10 million net worth that we studied in the Millionaires study, that's what we found over and over and over again. We did not find them playing trends. We did not find them playing fads. They were not gold bugs. They were not Bitcoin boys, Bitcoin bros. They were not any of that. They were just like, they're the tortoise, the boring, steady, every month the money comes out of my check into the 401k, and I got a match.
And then they call us at 58, and they're like, well, we're looking to retire. How much is in the 401k? And they're like, 800,492. You know what I mean? And then our Roth has this, and you're like, holy crap.
There you are.
Well done.
And they call this show every day.
Yep.
And every weekend they have for 30 years. So that's the end of that speech, Joseph. But thanks for letting me step up onto the old apple box and just give it a yell.